Ladies and gentlemen, welcome back to the channel. In today's episode, we are going to be discussing this market from a broad market perspective, what happened today, what's going to be happening tomorrow that could move the markets, and I do have a clip or two I want to share with you from CNBC, one of which is talking about how we have a really good backdrop for 2026 for stocks to do well, and how we should be set up for an end of the year rally, okay? Now, both of those things are important because we've talked about on this channel, we do have a pretty good tactical setup for a year-end rally. But we have a really good setup for next year as well, right? Next year looks like it could be a really good year for specifically AI stocks, for a stock like Tesla, right? And that could help fuel a tactical rally at the same time. If you're a hedge fund or institution, you're looking out to 2026 right now. It's hard to not like the setup that we have. Okay, lots of catalysts coming, lots of tailwinds coming. Consumers should get better. Inflation should improve. AI investment adoption is alive and well. I mean, just to point out a couple of things there. New Fed chair coming, likely to get multiple Fed rate cuts. Okay. So do me a quick favor before we get into all of this information. Hit that like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's episode if you guys want to come join us and come invest alongside us. Now, first and foremost, tomorrow morning, we are going to have a couple of catalysts. First and foremost, top of mind, I would think, is the ADP employment change for November. So you have the BLS that does their jobs report. Well, you have the private jobs report, which is done by the ADP. And this one is for November. Now, last month for October, you had 42,000 jobs. You're expecting that number to drop to 10,000 in the November jobs report, the ADP jobs report, okay? So you're expecting a really weak number. This could move around the expectations for a rate cut, not in December as much. It's pretty much a guarantee we're going to be getting a rate cut in December, on December 10th, sitting at about an 85% chance of that. It could move the odds more for January, okay? For January, the odds currently stand at about a 27% chance of a rate cut in December as well as January, okay? This is actually up about 2% today, but the data tomorrow, if it does come in weak like that, is going to really raise the odds of that cut January 26th, okay? And that could have a positive impact on risk on assets. Now, if you get a really negative number, that could be really bad for stocks, though. So it's a dual-edged sword, right? You want slightly weak data, but not recessionary. 10,000 job ads, that's a little uncomfortably low in my opinion. I would want to see something a little bit higher than that, but Wall Street might like a 10,000 jobs report number. Maybe slightly negative would be okay also, but if you come in like really bad, that would be a problem. Now it's the holiday shopping season. I doubt we get like negative 80,000 jobs, although that's something we definitely need to be prepared for. Now, all of this data, export prices, import prices, industrial production, capacity utilization, all this stuff is for September. So it shouldn't be that important, but it could be, okay? Now, the other big set of data we have tomorrow morning is the ISM Services PMI. You're going to get the headline number that's expected to come in at 52.1. Last month you were at 52.4, so you're expecting a little bit of a move lower. But business activity, employments, new orders, and prices, arguably the most important one Wall Street will care about is the prices component. Okay, what do the purchasing managers in the services industry, PMI stands for Purchasing Managers Index, what do they think about inflationary pressures over the next 6, 12, 18, 24 months, right? That's what the prices paid component is going to tell you. So it's survey data. It's not hard data. It's survey data. But Wall Street does pay attention to this because services about 80% of the economy. And if we want rate cuts, you got to see the services inflation participate and, continue to make progress in going lower. Okay, so we do have some big catalysts tomorrow. We do also have some earnings as well today. And after hours, you had earnings from Marvell, GitLab, CrowdStrike, Pure Storage, American Eagle, Box, Okta, Asana. Tomorrow morning, you have Dollar Tree, Macy's, RBC, Sprinkler. So you're going to hear a little bit more about the consumer, at least from Dollar Tree and Macy's. And then in after hours tomorrow, Salesforce, Snowflake, C3 AI, UiPath, Five Below, Health Equity, and PVH. And then Thursday, you have Kroger's, Dollar General, Hormel Foods, Build-A-Bear Workshop, and TD Bank in the morning. And after hours, you have Rubrik, DocuSign, Centennial One, Samsara, ChargePoint, Ulta Beauty, Sportsman's Warehouse, and Hewlett Packard Enterprise. And then Friday morning, you have Victoria's Secret there. So you do still have some earnings. You have that economic data tomorrow. That's definitely going to move markets. But one of the bigger stories of the day today is actually crypto. Okay, this is a 30-minute chart here. So you're looking at the last 5 hours or so, if I were to roughly guesstimate. Bitcoin has went from 87,000 to 92,000, back down a little bit right now to 91,300. Okay, you've seen Bitcoin start to recover a bit. And this is a great sign because there was a lot of liquidations. There was, forced liquidations and margin calls. You can actually see here in this clip, it says crypto market hasn't recovered from October 10th liquidity event. This is something I've talked about for a while now. There's been a yen carry trade that's heavily concentrated seemingly in Bitcoin that has put pressure on this market. Think about it like this. If you're a hedge fund or institution and you have a big yen carry trade concentrated in Bitcoin, sure, you're facing liquidations and margin calls. Fine. You get margin called, you sell Bitcoin. But then what happens is hedge funds and institutions that have no participation in the yen carry trade, they're just invested in Bitcoin. Now their Bitcoin holdings are falling. Now they're coming under pressure. They're being forced to sell, potentially getting liquidated as well. So that's why there is this correlation between crypto and the stock market. And what we've seen recently is crypto and stocks have really followed each other. Now, Bitcoin having, led this recovery to the upside, and part of this today was the SEC and I guess new rules changing for enterprises. Blah, blah, blah. Who cares? Okay. Is it that impactful? No. Bitcoin was just in need of a relief anywhere it could take it. And I think it spurred a lot of shorts to cover on short positions. But Bitcoin has led first, right? Bitcoin sold off first, and then stocks followed suit. Bitcoin rising first should lead to stocks rising as well. And again, we do have a really good tactical setup from here, assuming we don't get any huge surprises with economic data or the narrative shifts all too much. We're in the holiday season. Tax loss harvesting's pretty much over with. We have very bullish, seasonals at play here. And the chase, right? Hedge funds and institutions that are underperforming this market, they don't want to be so negative versus the S&P. If you're up 7% right now and the S&P's up 15% this year, that's putting a lot of pressure on these firms. So a year-end chase, makes a lot of sense from that perspective, but it also makes a lot of sense for 2026 as well, because we are expecting it to be a good year. Now, specifically for Tesla, I think Tesla is one of those sweet spot kind of stocks where it's burgeoning onto the AI scene, targeting multi-trillion-dollar industries that is in a cyclical recovery phase in just the auto business in general. Interest rates, weak consumer, those things getting better in 2026 will also help Tesla. But, Tesla's not a penny stock. Tesla is not a no revenue company, right? Tesla's a very established company breaking into these brand new fields of growth and profitability, right? Robotics and AI are going to be a lot more profitable for Tesla than the auto business ever was or ever could be. So I think, Wall Street's going to start and I think they have already done this, but I think it's going to continue into the end of this year in 2026, they're going to start looking at Tesla as, hey, you know, I can invest in hypergrowth AI without taking hypergrowth AI kind of risks, right? Now that Elon is contracted to be the CEO for the next 10 years, there's a lot of less risk in that. Elon Musk has said recently he has no interest in being involved in politics, right? So I think Tesla's really in a sweet spot for an end of the year rally and really for a good 2026. Now, in the very near term, you want to get above that 50-day moving average at about $434 per share. Okay, you're right between these moving averages right now, and I'm all the way zoomed in here. The 20-day moving average has served as support. That's at about $423 per share. And the 50-day moving average has served as resistance. The last 3 days, today included, on both sides, the last 3 days, we have touched the 20-day moving average and the 50-day moving average every single day, right? Besides, I mean, I guess you technically didn't hit the 50-day moving average on November 28th, but basically, right, you're ping-ponging back and forth at these moving averages. The first one to break could give you quite a large move. Now, I would think it would be a break to the upside with all of the positive things that we were talking about in today's episode. But again, you never know. Tomorrow, you're going to get a big move from the ADP employment change. It might come in a little on the weaker side, which could fuel risk assets, as it looks like the Fed might be more willing to cut in January. Now, I do want to share this clip with you from CNBC that says, "We are all clear for a year-end rally," says HSBC's Matt Kettner. Take a listen. It's only about 4 minutes long.
Losses, though, even after last week's big rebound. Historically, December has been a seasonally strong month without much volatility. Will this December prove to be the same? Well, joining us now is Max Kentner. He is Chief Multi-Asset Strategist at HSBC. Max, it's great to have you back on the show. And let's start right there, because historically, December tends to be one to remember for all the right reasons. How do you see this market shaping up right now into year-end?
Yeah, thanks for having me. Look, I don't think this December will be awfully different. Actually, when we look at the December Fed meeting, most likely they are going to cut. I don't see really much change from the Fed there, and also in terms of language. So that probably is pretty supportive. But overall, I think perhaps markets and investors have extrapolated a little bit too much of that November sell-off, or should we call it mini correction, particularly around crypto. We've had an awful lot of questions around what this crypto sell-off means for equities, and fundamentally there isn't an awful lot to do really with the broader risk asset spectrum. In fact, what this correction has done in November, it's brought back really a lot of our shorter term positioning signals back towards sort of buy territory. So a lot of short term hedging going on, VIX futures curve, put call ratio, option skews, all of those things really a week ago flashing and still being closer to a buy signal rather than a sell signal. So that really should mean all clear for a year-end rally.
Interesting. So would you be tilting towards risk on here after the rotation we saw in November?
Yeah, absolutely. 100%. So, I mean, we've been saying last week, look, this is exactly the sort of non-fundamental dips that you should actually be hoping for. In reality, you know, when we speak to investors and they say, you know what, yeah, we probably missed the rally a little bit, but we're waiting for the dip and we'll buy the dip. We're buyers of the dips. You know, I think the worst dips are the sort of dips where you say, well, it's perhaps as a reaction to, like we've seen right now, the reporting season, where perhaps, you know, the earnings beat rates are much lower than expected, and then you start to question the fundamentals. Whereas when you look at it this time around, it's sort of, you know, our tech companies, our AI companies that are mostly single A and double A rated, you know, are they issuing already too much debt? That makes fundamentally not a lot of sense. You know, this crypto sell-off, all of this stuff really hasn't made an awful lot of fundamental sense to us.
Well, I mean, to some people, the rise in crypto didn't make a lot of sense either. But I'm curious why you think the sell-off isn't sustainable, given that we're up about almost 16% year to date still. And there are these questions about what the data really say, because we haven't gotten all of it post-shutdown. And we've got this holiday season to navigate where some people still have questions about the consumer, particularly the working class consumer.
Well, I would say when we look actually at somewhat higher frequency data on consumption, that still looks like the U.S. consumer is not only in a healthy state, but actually is still rock and roll. Look at the Chicago Fed's cards data that's been going up despite the government shutdown. When you look at weekly retail sales, they've actually been rebounding in the last couple of weeks. Even Visa Spending Momentum Index has been rebounding since summer. We've heard from numerous retailers that Black Friday sales were actually quite good. So I would argue that not only is the US consumer pretty resilient, but it's probably looked, at least that's what the high frequency data is telling us, it's probably looked through the government shutdown noise.
Okay.
And the only other thing fundamentally that also has changed in November is that earnings estimates for Q4 have been slashed even more. So we have a setup
Okay.
where fundamentally
So, Max,
consensus again is questioning the earnings backdrop.
over the last couple of years, a number of folks have been saying everyday people should have crypto, Bitcoin specifically, as part of their portfolios. With this volatility, is it just another risk asset, or is it potentially more prone to volatility because of the leverage out there?
Yeah, look, I think what this is showing is that actually this is even more positive for gold rather than crypto, right? We have this whole debasement or this talk about debasement trade and this talk about the end of the dollar as a reserve currency. Now, I don't believe in that at all. But if you want to hedge against that, I think what it has, what really has shown in the last 2-3 months is that actually the proper debasement, the proper de-dollarization hedge, if you want to hedge against that, is probably much more in precious metals rather than in crypto, given there's much higher volatility and given that, there might be some regulatory burdens. Now, I don't know whether they will come true or not, but there might be some regulatory headwinds that clearly precious metals, at least relative to crypto, are not really.
Now, I do want to share with you this new video out from Tom Lee today as well. This one's a little bit longer, so if you don't care, skip past it. But Tom Lee says 6 reasons for stocks to rally in December. Take a listen.
Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the lead portfolio manager for Fundstrat's family of Granny Shot ETFs. This is our update for the week of December 1st. Just a reminder, a few weeks ago we launched the Granny Shot ETFs expanded family, GRNJ for Fundstrat mid-cap, small mid-cap ETFs, and GRNI for Fundstrat's U.S. large cap and income ETF, which generates income using derivatives. For the week ending November 28th, assets under management for GRNY are $3.8 billion, for GRNJ, $84 million, and for GRNI, $23 million. As for performance over the past week, large cap Granny had total gains of 5.6% compared to 3.74% for the S&P 500, or relative outperformance of 184 basis points. For GRNJ, the return over the past week was 8.2% compared to 4.9% for the Russell 2500, or 341 basis points of relative performance. And for GRNI, large cap income gained 4.9% compared to 3.74% for the S&P, or 118 basis points of relative performance. And over the past month, year-to-date, Granny Shots is up 25% compared to 18% for the S&P 500, and that's relative performance of positive 706 basis points. And for GRNJ, since inception, up 6.75% compared to 5.88% for the Russell 2500, or 86 basis points of relative performance. And for GRNI, since inception, positive 2.34% compared to a 2.69% gain for the S&P, or 35 basis points of underperformance. Every month we will give you an update on flows, and flows for the month of November were $367 million for the Granny family, $191 million for Granny Shots, $55 million for GRNJ, and $15 million for GRNI. So let's talk about the macro and 6 reasons why I expect stocks to rally in December. First, the Fed is set to cut rates in December, and I think maybe more importantly, QT or quantitative tightening is ending. Now, QT started on April 2nd when the Fed began to taper its balance sheet, and that is ending now more than 3 years later. And as you can see on this chart, the Fed's balance sheet has shrunk dramatically. The last time the Fed ended its quantitative tightening program was in September 2019, and that program lasted about 18 months. But let's look at the S&P 500 during that period of time. When QT ended on September 19th, okay, you can see the S&P up until that point was in a range bound, in fact, had a pretty nasty correction, but then quickly gained around 17% over 16 trading days. So it was significant for equities once QT ended. So that's something to keep in mind. Now, as far as the Fed taking action in December, I want to start with the Bank of Japan because it looks like the odds have shifted for the Bank of Japan to actually hike rates in December. 61% odds according to Polymarket. Now that contrasts with what the Fed's planning to do. Looking at Polymarket, again, market-based odds, an 89% chance the Fed cuts in December. So we're really talking about two central banks pursuing different paths. But again, for U.S. equities, it's really what the Fed's going to do. And finally, with regard to the Fed, President Trump just recently said he knows who he's going to pick as Fed chair and announce it soon. I'm going to guess it's going to come around or slightly after the FOMC rate decision in December. But markets are anticipating this to be Kevin Hassett. Number 2 reason for expecting a rally in December is that the economy is still healthy. There's still plenty of pent-up demand, and the ISM manufacturing has been below 50 for 3 years. Now that is going to be updated this week for November, and housing has plenty of pent-up demand. Number 3, the government shutdown's over. We've had a blackout of economic data, and that markets don't like the lack of information. That's going to have a restoration of visibility. Number 4, there's performance chasing. Investors are off sides in November because a lot of funds actually threw in the towel. They just thought the markets made the highs for the year. And already 2025 was the worst year for fund managers, with 78% trailing their benchmark through October. Number 5, stocks got oversold. And I think especially when you look at RSI. This is daily RSI for the S&P year to date. And the daily RSI fell to 35 in November. That's the most oversold it got since the April tariff lows. And as you can see on this chart, once you made those lows on the RSI in April, market began to rally pretty sharply. And lastly, it's seasonal. December usually finishes strong. And given the pullback in November, I actually think December is shaping up to be a good year. Good month. And as far as macro data this week, there's a lot. The ISM manufacturing for November comes out on Monday. On Wednesday, November ISM services. And on Friday, we get a trio of data. But the one the market's probably going to focus on most is core PCE for September. And there are some companies reporting this week that are granny shots. CrowdStrike on the large cap side. And there are 5 mid-cap grannies reporting: MongoDB, Pure Storage, UiPath, Donaldson and Company, and Samsara. Most of these are AI-related stocks. And as for individual stock performance, let me just highlight. The top 5 performers for Granny and Granny Income were Robinhood, Broadcom, SoFi Technologies, Arista Networks, and Tesla. And these are basically AI-related names. The bottom 5 are Costco, S&P Global, TJX, NVIDIA, and Deere. On the SMID side, the top 5 performers were Lumentum, Riot Platforms, Bloom Energy, IonQ, and SoFi Technologies. And the bottom 5 are East West Bancorp, Weatherford International, Watts Water Technologies, Pegasus Systems, and Qualys. And as far as themes go, I want to highlight the three that contributed most to the relative performance. The first are millennials. As you can see, it was a bigger contributor to the SMID-cap portfolio. The second is the global labor shortage and AI-related stocks. And the third are energy and cybersecurity-related names. That's it for now. Thanks for listening, and I'll speak to you soon.
So yeah, the path looks pretty clear for a year-end rally, and honestly, it looks pretty good for 2026. But then again, we do have Catalyst tomorrow. Anything can happen. Be mindful of that. Bitcoin recovering a little bit more. It did have a weird little, shouldn't say little, but like $900 sell-off. Maybe 2 hours ago or so, and it's starting to come back a little bit from that. So we'll see what happens with crypto. Crypto, if it still is a leading asset to the markets, that should mean a resurgence of some of that risk on trade as well, which should benefit Tesla. And I don't think it's crazy to say Tesla is going to be a $500+ stock by the end of this year. From here to hit 500 would be upside of about 16.3%. So it is quite a rally in December, but we've seen a lot crazier before. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's episode if you guys want to come join the trading community. But with that said, have a great rest of your day, and I will see you in the next one.